Consumer habits are shifting, and it reveals a change in our economy. As always, we have to dig just a little below the surface, but I think you're going to find what we discovered with the data to be quite interesting. Last week, it was reported retail sales. This is on a month over month basis. The strongest segment, gasoline stations. Weakest segment, non store retailers. And we see a big divergence between the two, and that is very telling about a segment of our economy. Now, specifically, non-store retailers on a month-over-month basis was down 1%. On a year-over-year basis, it's up 7.5%. So non-store retailers, that again, that's online shopping. That's one of the strongest segments historically in our economy. But it looks like the trend might be changing. Here's gasoline station sales on a month-over-month basis of 3.1%, better than last month. In fact, the best level we've seen since early 23. On a year-over-year basis, gasoline station sales, quite remarkable. It's in positive territory, up 4% for the first time since late 22. On the other hand, on a month-over-month basis, retail sales, that's online shopping again, down 1.2% following last month's 2.5%. This was a disappointment. And that 7.5% year-over-year basis, what we spoke about, that's actually not a good number. It's one of the weakest numbers we've seen for online shopping in quite a while. Now, gasoline station sales are rising while online shopping declines. Why is this important? The consumers are deferring to essentials at the expense of luxury goods. We need gasoline to get to work, but the luxury goods like online shopping, we have to defer to the essentials. This has happened before, by the way. Let's go all the way back to 1999 to 2001. In red, gasoline station sales. In blue, non-store retailers. Certainly, online shopping was a little bit different about 20 some odd years ago, but nevertheless, we see a change in the trend. As the market got very toppy, all of a sudden, gasoline station sales overtook the online shopping, the non-store retailers. Well, the same pattern also took place in 2007. We see here again in red, gasoline station sales, in blue, non-store retailers. And then when the economy got itself in a little bit of trouble in late '07 and early '08, we see gasoline station sales overtake non-store retailers. We can think about this in the same way we consider the stock market. When we consider very strong bull markets, technology stocks like Nvidia and Apple and Microsoft tend to do very well. But when the economy gets itself in trouble, capital moves back into the utilities, the more stable components of the Dow, for example. And we're seeing a shift, so to speak, not only in stocks, but also now we're seeing it in terms of the sectors reflected in retail sales. Well, this is where we are now, 22 through 24. In red, gasoline station sales were quite weak. Non-store retailers were pretty strong, but the trend is now shifting. We're seeing a weakness in online shopping and a strength in gasoline station sales. Again, year-over-year basis, it's the same way we looked at the year 2000 and 2007 in the prior charts. We haven't crossed over yet, but the trend is troubling. What's also troubling is what we reported last week. We call it the manufacturing freeze. We spoke about 4 key economic numbers that speak directly to the weakness in the manufacturing sector. Philly Fed, Empire State Manufacturing, capacity utilization, and industrial production. In particular, the capacity utilization numbers are actually quite troubling. And I think that you're going to find what we discovered here to be quite interesting.